Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at specific strategies for trading the head and shoulders pattern and the reverse head and shoulders pattern, two patterns which can be considered reversal patterns when they show up on a chart. In today's lesson we're going to look at something which is known as the wedge pattern, which is unique in the sense that it can be considered either a reversal or a continuation pattern depending on the shape of the pattern and whether it occurs in an uptrend or a downtrend. So let's get started.
Okay, so we're going to start this one out by looking at the falling wedge pattern, which is characterized by a pattern which forms when the market makes lower lows and lower highs with a contracting range. When you find this pattern in a downtrend, it's considered a reversal pattern, as the contraction of the range indicates the downtrend is losing steam. When you find this pattern in an uptrend, it is considered a bullish pattern, as the market becomes narrower into the correction, indicating that it is running out of steam and the resumption of the uptrend is in the making. So let's look at a couple of examples here. You see here a chart of the dollar index, and you see the downtrend in place there. You can see the falling wedge in place there, and you can see the two lines, the two trend lines coming together as the pattern or the market continues into the downtrend, indicating a contraction of the range and a potential reversal there, which we did actually get in this instance. On the opposite side of that, you see the uptrend on the left-hand side of the chart here. You see the falling wedge there. You see the contraction of the trend lines on one another, indicating the correction narrowing into the bottom there and indicating a potential reversal or a potential continuation of the uptrend. Okay, so the market corrects and then turns back around into the original uptrend. So you can see why it's considered a continuation pattern there. The rising wedge pattern, on the other hand, is characterized by a pattern which forms when the market makes higher highs and higher lows with a contracting range. When you find this pattern in an uptrend, it's considered a reversal pattern, as the contraction of the range indicates that the uptrend is losing steam. When you find this pattern in a downtrend, it's considered a bullish pattern, as the market becomes narrower into the correction, indicating that that the correction's running out of steam and the resumption of the downtrend's in the making. Okay. So you see here, rising wedge, you see the start of the downtrend to the left of that, see the break below and the continuation of the downtrend on that. You see the contraction of the two lines together, two lines coming together there, contraction of the market trend indicating it's losing steam, or that the correction is losing steam, and a resumption of the downtrend. Here we have the uptrend in place. On the left-hand side of the chart, we see the rising wedge at the top of that, indicating that that uptrend is losing steam, and we see the reversal actually coming into play there as well on this one. All right. So that's our lesson for today. You should now have a good understanding of the falling and rising wedge pattern in situations which they're considered a reversal pattern and continuation pattern. In tomorrow's lesson, we're going to look at specific strategies for trading each of these patterns, complete with entry and exit points. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below. And have a great day.